Friends, welcome back to the channel. Today we are going over 5 investing mistakes that beginners make. If you're new here, my name is Sam, and on this channel we cover personal finance, investing, entrepreneurship, lifestyle, all of the above. Now, just to preface, I'm just a guy on the internet and I've made these mistakes myself, so I just wanted to share, but obviously it's not financial advice, it's just for entertainment purposes. But let's get into it. The first mistake that I see beginner investors making is that they do not have enough cash reserves. So likely what happens is they get their first paycheck or they want to start investing, so they open a Robinhood account, they throw some money in a stock that they've heard of like Facebook or Google, and then they don't have enough cash if an emergency came up. Let's say your assets are down 20-30% at the given time that you need the money. You can't just liquefy that asset that you wanted to hold long term. So you need to make sure that you have 4 to 6 months saved up in cash in a high yield savings account before you start investing. Very crucial. You do not want to miss this step. Okay, I see a lot of it happen to my friends, and it's really bad because they end up needing to borrow money. Don't be in this position. You want to make sure that you can hold on to those assets long term and that you're not forced to sell them because of liquidity issues on your part. Mistake number 2 that I see beginner investors making is that they try to time the market when they should just be dollar cost averaging. So I think Benjamin Graham actually coined this term. He wrote one of the best value investing books of all time, which I'll talk about at the end of this video. Graham coined the term dollar cost averaging, and basically what it means is that you buy a share no matter what the price is over a certain period of time at equal intervals. So basically you would buy that same share or index at the same time every week at whatever price it is. And the reason you might want to do this is because you decrease your average cost per share by dollar cost averaging, and you decrease your potential for volatility in your portfolio. Mistake number 3 that I see beginner investors making is that they gamble and not invest. So it's very common, I think, when you first get started out, you open a brokerage account and you start to throw your money at some stock that you've heard of from your friends, that you saw in the news, whatever the case is. It's some company that you really don't know much about the financials of the company. You're just buying the stock to buy it. I'd really recommend against doing this when you first get started out. There's time for a more speculative portfolio once you get greater and greater in your investing knowledge, but at the beginning you really don't want to just buy random stocks. Along with this, number 3 is number 4, which is not investing in index funds. Like I said, when people first start out, they want to throw their money at Apple, Google, all these big tech companies. I think for the first year of investing, you really should just invest in index funds. Only 8% of portfolio managers actually beat the market, and most of those people can't do it over a long-term period. So the greatest investors like Charlie Munger, Warren Buffett, all these people agree that index funds are the way to go. So an index fund is just a fund that tracks a certain sector of the market. So for example, VOO, V-O-O is the ticker sign, that tracks the S&P 500, which are the top 500 publicly traded companies in America. The difference between an index fund or an exchange traded fund, ETF, and a stock are that you are participating in diversification. So in a single stock like Apple, Facebook, Google, whatever that might be, if that company goes under, obviously your stock is worth nothing. Whereas in an index fund, you have an exposure to all these different companies, and it's basically a pool of a bunch of different stocks. In summation, most of the top investors of our time agree that index funds are the way to go because of diversification, and they have a great track record over a 30-year period of producing anywhere from 8 to 12% annual return. And number 5, the last mistake that I see beginner investors making is following trends and not doing the research for themselves. So Warren Buffett has a really great quote that says, investors should be fearful when others are greedy and greedy when others are fearful. So very likely if you're following any type of financial news, whether it's on Reddit or a more traditional news source like CNBC, if you hear about a stock that's doing well or something you should buy, it's probably too late to buy. In other words, often when there's a craze or everybody knows about a certain stock that's performing well, it's too late. It's very likely at the top of the market, and if you buy, you're only going to be buying at its highest point. This isn't always the case, and obviously don't take this as advice for every situation, but I think it's just a good rule of thumb to follow is go against the crowd. I also wanted to leave you with 2 books that I think are really great for people just getting started in investing. And the first one is A Random Walk Down Wall Street. I'm actually currently reading this for the 2nd time, and it's a great book. The first couple hundred pages are a bit dry because they talk about the history of the market and trends, but the last third of the book has really great practical implications and strategies for investing. The second book that I think is really important for beginner investors to read is The Intelligent Investor by Benjamin Graham. Now, this one is a little heftier than the first one, but Benjamin Graham was Warren Buffett's mentor. He is the father of value investing. Value investing is basically just a strategy of picking stocks that appear undervalued compared to their intrinsic value. He talks about it in the book. I'm sure you'll find it fascinating. But yeah, I'll leave a link to both of these books down below in the description of the video. If you want to buy them, it helps out the channel a little bit. Thank you for your support with that. That's all I have for you today. Thank you so much for watching. I very much appreciate your time. Do not forget to subscribe. Leave a comment down below. Let me know your favorite investing book or some tips and tricks that you have about investing. Would love to hear what you guys have to say as well. Thank you again, and we will see you in the next one.